The next topic we are going to discuss about investment process. Investment process is a tool that includes buying asset and expecting more return from them in future. So analyzing an asset's types and their risk return ratio is essential before making an investment. But in the investment process can be overhauling some of these so many optional availables today. Here we are having a different steps over here, so we have to follow the different steps while making an investment process. The investment process is a systematic approaches that guides the investors in making an informed decision about the allocation of their capital, various asset, optimum returns, etc. So these are that is a investment process over here. We are having a different typical involves in a several steps, which can be depending upon an investor goals and their time horizon, risk factors, investment strategies, etc. The step one is setting up of a financial goal. It includes the clear define your investment objective and whether it's a wealth accumulation over here. The next one is assessing the risk tolerance. In this you have to understand your own risk tolerance level by evaluating your capacities and willingness to accept fluctuations in the value of your investment. The factors such as age, financial situation, investment experience, and personal influencing risk tolerance are involved over here. The next one is developing an investment strategy. In this, it is based on your investment goals and risk tolerance. It formulate an investment strategy outlining how you will allocate your capital across different assets classes, that examples stocks, bonds, or real estates, commodities, to achieve the diversification and optimize the risk adjusted return over here. The next one is that is diversification of investment portfolio. The diversification of investment portfolio is a golden rule for investment. It refers to spreading the investment across the different asset classes such as stocks, bond, mutual fund, and real estate. These strategies are migration risk by reducing the impact of poor performance in any single investment. Diversifying ensures that a downturn in one sector does not diversify for a entire portfolio balancing or potential level. The next one is conducting a risk and analysis over here, risk or a research over here. In this, it has a thoroughly potential or a risk investing opportunity within the asset classes, analyzing the factors or a historical performance, fundamental investors, economic outlook, industry trends, and company fundamentals to identifying and promising the investment options. The next one is asset allocation. In this asset allocation, it determines the optimum allocation of our investment capital among various assets classes based on your investment strategy, risk tolerance, and market condition. Asset allocations aims to balance risk and return by spreading an investment across the type of assets. Next one is selecting investment. It is a choice of specification securities or investment product that align with your investment or strategies and assets allocation plan. These steps may involve selecting an individual stocks, bond, mutual funds, real estates, etc. It is an alternative investment based on your research and analysis. The next one also, it's have an executive trade over here. It implements an investment decision, buying or selling of a security through brokerage accounts, investment platform, financial advisor, considering the factors such as transactions, cost, tax, liquidities, and time when it executes its trade. The next one is monetary performance. In this monetary performance, the performance of our investment portfolio to track the progress over towards your goal and assess the effectiveness of your investment strategy. It gives a review key metrics such as portfolio return, volatility, assets allocation, and individual security performance, etc. The next one, it has an a review and adjustment over here. It reviews the conduct of a periodical review for investment strategies and portfolios to evaluate whether the remaining allocation with your investment goals and risk tolerance and market conditions which adjusted your investment opportunities or needed based on changing the circumstance, new opportunities or revised objectives over here. The next one is stay informed over here. The stay informed means it has an continuously educate yourself about the investment principle, market trends, economic developments and regulatory changes to make informed decisions and adapt to evaluating the market conditions over here. So these are all the by following these steps investors can develop a systematic approach to managing their investment and working towards their financial objectives. It is an essential to take the financial advice if needed and exercise due to when it making a decision over our investment. So these are all the different points occurs in a decision process. Thank you.